Credit cards are one of the most powerful tools available, but they can also be the first thing to destroy your finances. The same piece of plastic that earns someone free vacations can bury someone else in debt. The question is, are they good? Are they bad? The answer is both. Today, we're going to talk about the good, the bad, and the ugly side of credit cards. How to pick the credit card that makes the most sense for you. How does interest on a credit card actually work? And perhaps most importantly, are credit cards right for you? So let's start with the good side of credit cards. One thing they are great for, especially for younger individuals, is building credit. What that can lead to in the future is the ability to qualify for loans, whether that is student loans, a mortgage, a car loan, and a credit card can be a great tool to help you get started building that credit. By establishing a credit card, you're not only going to be able to start building your credit history, you're also going to be able to improve your score over time as long as you use them correctly. Oftentimes, there are rewards and benefits associated with credit cards. That could be cashback on your purchases, building up miles that can be used for travel, hotel points, travel credits, among other things. Sometimes they'll even provide extended warranties, exclusive discounts, and offers as well. Credit cards also offer a level of convenience and security, as oftentimes it is a lot easier to dispute a credit card transaction than it would be if you were using a debit card. Sometimes, too, credit cards will provide you with a nice spending summary so you can see the categories in which you're really spending in. Now, there are certainly apps out there that can do it for you, but oftentimes credit card companies will provide that data to you as well. As I mentioned earlier, credit cards can be a great tool for building your credit. And oftentimes, people will get their first credit card maybe when they're 18 years old or going into college. And one thing I always like to tell people is it's very important to keep that oldest card not only open, but active. And that's for a couple reasons. One, it's going to factor into the length of your credit. So when they're calculating your credit score, one of the components of that score is going to be how long have you had credit open for? And oftentimes we'll actually look at the age of your oldest account, which for many people is their first credit card. So if they close that credit card, they're not only going to reduce the average length of their credit, they're also potentially getting rid of the oldest credit card that they have, which could negatively impact their score. It's also important to note that if you're closing out that old credit card, you might be reducing your overall credit limit, which could hurt your utilization, which takes a look at how much you're actually using on the card versus how much your available credit is. And that's not necessarily just for that card in particular. They look at that when they're factoring in all of your credit limits that you have available to you. For many people, their oldest credit card might be the one with the least amount of benefits. They just got it to get their foot in the door and start their credit journey. But what can happen, and the trap that I've seen people fall into, is that they stop using that card and credit card companies will actually cancel a card if you don't use it. So what I oftentimes will recommend is maybe throw a subscription onto that card so that you know it's at least getting used every month, or maybe you dedicate that to be your gas card or small purchase card. Just because credit cards can be great tools, it doesn't mean they're harmless. Sometimes those attractive features are what end up getting people into the most trouble. Studies consistently show that people tend to overspend when they're using plastic or when they're using a credit card. Why is that? It's because it doesn't necessarily feel real. You're just swiping that piece of plastic. The money's not necessarily coming out of your bank account right away, and that can get some people into trouble. So one thing to keep in mind is just because you have a balance on your credit card, that might not be accurately reflected in your bank account balance, and you have to be mindful of that so that you don't overspend. There's also less emotional pain when you're swiping that piece of plastic as opposed to handing over cash. It just doesn't feel as serious. No one ever became wealthy by earning 2% cash back while carrying a balance at 25% interest. Some of the signs to look out for if you're overspending are that you're afraid to look at your statement balances. You're carrying a balance at any point in time past your due date. Because once again, the danger with credit cards is the high interest nature of them. Oftentimes, the interest rate on a credit card will be anywhere from 18 to upwards of 30% sometimes, and it's the highest form of interest that many people will face in their lives. So the question is, how do you stop credit cards from becoming dangerous to you? One method that I use personally, and I suggest to my clients that maybe have had spending issues in the past, is pay off the credit cards before they're due. For a couple reasons. One, if you're paying them as you're using them, you're receiving the cashback or miles benefit that you have associated with it, but you're your bank account is going to update and reflect the real time balance. So instead of you carrying a few $1,000s on your credit card and waiting till it's actually due, paying it off early allows you to see in your bank account real time how much money you actually have to spend. And that really helps curb the overspending. Also, too, automating those payments, making sure that on a monthly basis, your credit card bill is getting paid off helps prevent you from carrying a balance from month to month. Once again, that's going to be at a very high interest rate if you do that. Lastly, reviewing your statements if you're running into issues with overspending can also be a good practice because it at least lets you know where you're spending your money on and it can help you reduce in those specific areas. A credit card should really only be a payment tool, not a financing strategy. Because in terms of financing strategies, it's going to carry one of the highest interest rates out there. As I previously mentioned, credit cards typically will carry a high interest rate, sometimes even into the 20s, pushing 30. And it's interest that will actually accrue daily if it's not paid off in full at the due date. Now, that doesn't necessarily mean that you're accruing interest 24% a day. The rate that you see is going to be an annualized rate, but it is accruing daily. Also, people get caught up in the minimum payment trap. When you're making minimum payments on a credit card, you're primarily paying for the interest and only a small amount is actually going towards the principal, which is really going to kill you in the long run because you're just continuously accruing this interest and not really making a dent into the principal, which is going to help reduce your future burdens. Compound interest can either make you wealthy or the bank wealthy. If it's compound interest on the credit card, you're certainly making the bank wealthy and not yourself. While missing a payment can impact you from an interest rate standpoint and an interest paid standpoint, it also has the ability to hurt your credit score because one of the factors of your credit score is you paying on time. By paying on time and in full, that's going to help your credit score. And if you're not doing that, it can hurt your credit score. And it is one of the most impactful factors of a credit score. So how do you avoid paying interest on credit cards? It's just making sure that your balance is paid in full by the due date. Let's talk about an example. Let's say the end of your statement period is June 1st and your payment is due July 1st. There is a level of a grace period that the credit card companies are giving you. Even though it's for transactions that you spent through June 1st, your payment's not actually due until July 1st. And as long as you make the payment by July 1st, no interest will accrue for that transactions. Now, let's say your statement balance was $2,000 and by July 1st, you only paid $1,000. Well, starting July 1st, you're now going to be accruing interest for the $1,000 that you didn't pay. You lost the grace period. It's also important to note that a lot of credit cards, if you are carrying a balance, any purchases that you make on that card that are carrying a balance will automatically start to accrue interest. So just keep that in mind. If you're ever carrying a balance on a card, you might not want to be using that card because any purchases you make could be accruing interest instantaneously. Once you start carrying a balance, the game changes. You're no longer getting an interest-free loan from the bank. The bank is now charging you rent to use their money. I want to briefly talk about 0% interest cards because I've seen people use those over the years as a way to get out of credit card debt. Maybe they're currently have debt on a credit card that's at 24% and they have the ability to transfer that balance to a 0% credit card. Now, there are nuances associated with the 0% credit cards, and I want to briefly touch on those. First of all, oftentimes there's going to be a transfer fee to move those funds over to the 0% card. So let's say you have a $10,000 balance on your 24% interest credit card. You want to get out of that 24% interest. They might charge you 3 to 5% just to move it over to the 0% card. Furthermore, there's usually a defined period in which that interest is at 0%. Maybe it's 6 months, maybe it's a year, maybe it's 18 months. But it's important to note during that time where it is 0% interest, any payment that you make is actually going directly towards the principal, which is helping to bring the balance of that card down. If you're ever playing the transfer game to a 0% card, it's important that you remain disciplined because at the end of that period, if you aren't out of that credit card debt, interest is going to start accruing and you're going to find yourself right back in that situation. So if you're playing that game, you need to make sure you're actually changing your habits and you're not just trying to bridge it until the next time you do a balance transfer. So let's briefly touch on the different types of cards that are out there. You'll see cards that offer pure cash back. Some have more travel-centric rewards associated with them. When helping people pick a card, I always encourage them to Pick a card that fits their needs most. If they do a lot of traveling, maybe they travel a lot for work, or they like to just travel a lot for going on vacation, then a travel centric card might be the right option for them because they're getting a higher multiple on miles than they maybe would be if they were doing cash back. Maybe those travel cards are more apt to offer hotel credits, flight credits, discounts if you're purchasing from their travel partners. Now, for the other side of that, if people aren't traveling, then the pure cash back cards also provide a level of benefit too. Maybe you can get 1.5 to maybe even 2.5% cash back on all your purchases. Oftentimes with the cash back rewards, they'll offer some level of benefit if you redeem those cash back points or dollars for something other than pure cash back. I know with the credit card that I use, for example, if I use those points to purchase something from a specific store, my points might be worth 25% more if I'm redeeming them through one of their partners as opposed to just taking the pure cash back. So instead of getting $100 cash back, I might be able to go purchase an item that's worth $125 worth of value for only $100 worth of my points. Also, you want to consider whether or not a free card makes sense for you or if you're using a card that has an annual membership fee associated with it. The trap that I see people fall into with the annual membership fees is that they're not actually getting the value back out of the card that it's costing them to maintain that membership fee. If you're not actually using all of the benefits associated with those annual fee cards, you're probably worse off for doing it, even though you may feel like you're better off because there's also a level of status that goes into some of these annual fee cards where it makes people feel a little bit more important or special because they have a card with an annual fee and they get to say they're a member of that card. A premium credit card only makes sense if you're actually taking advantage of the premium features that it has to offer. A lot of times you'll see these premium credit cards with high costs give you a level of credits. Maybe they give you credits to certain restaurants, or maybe they give credits on certain delivery services like DoorDash or Uber Eats. But oftentimes, if you're not actually using those credits, you're not getting your membership fee back out of it. Another type of credit card that you might see out there is store-specific cards. One thing I always like to note with those are they're really only worthwhile if you're actually frequently using them at that particular store. I wouldn't necessarily say it makes sense to have a store-specific card and using that as your everyday spender, just because the cash back, if not being used at that specific store, or the benefits associated with using that card at that specific store usually aren't the same way if you're using it in the grand scheme of things and not at that specific location. I also want to touch on the fact that credit cards are not for everyone, and it's important to know whether or not you're actually a credit card person. Credit cards have great features available to them, and if you use them properly, they're nothing but beneficial to you. If you're not overspending, if you're not carrying a balance, they're a great way to build your credit while also getting some rewards for doing so, like cashback, like travel benefits, or whatever other benefits your card may offer you. But if you consistently find yourself overspending, if you consistently find yourself carrying a balance, paying credit card interest, then credit cards just aren't right for you. And it might be worthwhile to not use them because they're probably doing more damage than they are actually benefiting you. If you're not a credit card person, that's okay. Using a debit card works just as well because at the end of the day, if it's hurting you by using them, you shouldn't be using them. Credit cards themselves aren't necessarily good or bad. They're simply tools. And if used correctly, there's a lot of benefits associated with them. However, if you're using them incorrectly, they can be one of the worst financial mistakes that you ever make. So if you found this video helpful, or if you know anyone that could benefit from it, I'd really appreciate you liking it and passing it along. Thanks for joining me today.